Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. And today we're going to answer a few of our viewer questions that we've received over the last couple of weeks. But before we get to that, I want to give a brief overview of what's been going on in the markets for the past week. Really, all I can say is we've just had a continuation of a lot of the same themes. We've had continued volatility. We've had continued low volume in trades creating that volatility. We have continued uncertainty in Europe, so we still sort of have the same continuation of themes. Some reasonable economic data domestically that's come out, but by and large, just sort of a same continuation of the themes that we've been seeing all along. So still hoping for that Santa Claus rally, but not necessarily seeing it materialize just yet. So hopefully I'll have some different news for you next week. But that is where we stand thus far this week. So before I get to our next questions, we're going to be joined by David Kroll with his Mortgage Minute, and we will be right back answering our 3 most frequently asked viewer questions over the last couple weeks. I'm Emily Johnson, and this is Money Matters.
Hello, this is David Kroll from Mortgage Network for the Mortgage Minute. It's almost Christmas, 10 days away, and I'm going to give you gifts today. David Kroll as Santa Claus. For the first time in 2 months, our long-term interest rates have a 3 in front of them. By law, I'm not allowed to get any more detailed than that, but the long-term 30-year fixed rates have a 3 in front of them for the first time in a very long time. Secondly, the combination of the discount in property prices times the lower rates equals almost a 70% discount in the cost of property here on Hilton Head over 5 years ago. So if you have any intention of buying a home here or of starting a family and buying your first home here, now is the time to do it. Have a Merry Christmas. Happy New Year. David Kroll.
Welcome back to Money Matters. So today I want to answer a couple of questions that we've been receiving from viewers over the last few weeks, and we've been receiving some of the same questions over and over, so those are the ones that we chose to address this week. And the first question, the number one question that I've been receiving is variations on the theme of, I hear all the time about high dividend yielding stocks, that's the place to put my money these days. Tell me what a high dividend yielding stock is, number one, and also why is that the place to be putting money, and what are your thoughts on that? So first of all, high dividend yielding stocks are typically value-oriented stocks. These could be utilities, companies with very strong balance sheets that are going to be paying out a portion of their cash flow in the form of dividends. Right now, high dividend yield is considered to be about anything above 2.5%. So you could see high dividend yielding stocks as 3%, 4%, up to 8%. And the reason for that is because the S&P, the broad index, is yielding somewhere around 2 to 2.5%. So anything above that is going to be considered high yielding equity. So the reason that you've been hearing that is a place to put money right now is because that's often a place to hide when there's a lot of volatility. Well, there's a couple reasons. One reason is because it's often a place to hide when there's a lot of volatility. So you hear a lot of the analysts and market mavens these days saying that is the safe place to be because you get paid to wait. If you're receiving a 3, 4, 5% dividend yield and you're receiving that over the course of a year, then if the market is fluctuating, or if the value of your stock is going down, then you actually are receiving some cash that should be buoying whatever that down movement is or whatever that volatility is in the market. So you're getting paid to wait. So that's one reason in a high volatility market or a very volatile market why people are suggesting high dividend yielding stocks. Another reason is because we're in a very low interest rate environment. And as interest rates go down, it's less attractive to have your money in bonds. So as you see Treasury yields going down to historically low levels, people that are living off of a fixed income or that are relying on the income in their portfolio are moving from bonds into equities. And the Fed is actually motivating that. The Fed, by keeping rates artificially low, is trying to motivate the movement of cash from bonds into equities. So if you're getting a 1.9% yield, say, on your 10-year treasury, you might then want to move that money from your bonds into equities where you're getting a 3-4% yield. But these are not necessarily created equal. You do need to be concerned if you're getting a 3-4% yield, you're obviously taking more risk than you would if you're getting a 1% yield or a 2% yield in bonds, because you have that risk-reward relationship that you have to consider. So another reason why high dividend yields stocks are attractive right now is because of the low interest rates in bonds. But you really, really need to keep in mind what your objective is. That's first and foremost what's important. If growth is your objective, high dividend yielding stocks, while they might look attractive right now in this very volatile market, they might be moving slightly less than what you're seeing growth stocks move, or stocks that have lower dividends. They might be moving slightly more in this very volatile market. If you're looking at transitioning from growth into value for that reason, because of that lack of volatility, really reconsider that and look at that move in light of what your overall objectives are. The reason for that is, as interest rates start to go back up again, and as we start to see the economy turn, which it will, and that actually is going to lead into our next question here in a second about interest rates, but as you see the economy start to turn, high dividend yielding stocks tend to underperform. And the reason for that is because while people have been going to hide in those high dividend yielding stocks, the value of those stocks have been kept up. And they do not necessarily tend to grow in lockstep with the rest of the economy, because there's been an inflow of money into those value-oriented stocks. So as the economy starts to turn, you're going to see greater growth coming from lower yielding stocks, from growth-oriented stocks that might only have a 0.5% yield or a 1% yield, but that's where the majority of the growth is going to come from. Those tend to be smaller companies, they tend to be more tied to the economy, and they also tend to move a lot faster when the economy starts to buoy. So you're going to start to see money, as the economy moves, move out of high dividend yielding stocks and back into growth. And you don't want to be, the last one sitting, what is it, the patsy at the poker table? There's a cliche, I'll screw it up. But you don't want to be the last one out of that trade. So you want to make sure that if you're moving into high dividend yielding stocks, that is in line with what your objective is. If you're living off of your portfolio and you need the income, perhaps that's a reason to be looking at high dividend yielding stocks. But I would not say that that's a good place to go to hide right now, because as the economy turns, you could very well get hit. You could see your principal decline as money moves out of those stocks and into growth. And you also need to consider the fact that you might fall behind when the market starts to rebound. So you want to be looking at growth-oriented stocks as well. So again, look at what your objectives are. If your objectives are in line with value and income, then perhaps that is the right place to be. If that's not what your objectives are, if it is exceeding the market or keeping up or exceeding the market over a period of time, then that is probably not the best place for you to be hiding right now. There's really nothing wrong with hiding in cash at the moment. If you're feeling like, and we get into this in just a second, but if you're feeling like the market is too volatile and you're looking for a place to hide, I really don't think that it's too bad a move to be hiding in cash right now and be looking at opportunities for nibbling at those growth-oriented stocks, at those smaller company stocks, at the lower yielding stocks, because there will be value there over time. We're seeing historically low levels. We're actually hitting levels that we saw back in 2008 in some growth-oriented stocks. So it really is a good place to be looking right now, to be nibbling at. So if you've moved money out of treasuries, if you have some gains that you'd like to protect, if you're going into year-end and you're making moves based on, for tax reasons, for tax loss harvesting, you want to go ahead and take some gains, you want to take some losses, etc., it's okay to move that money into cash and to hide in cash for a little while, because I think that you will see that there's going to be some great long-term buying opportunities in growth. So nothing wrong with high dividend yielding, but the overall theme that I want to communicate here is make sure that you're staying with whatever your long-term objective is, that you're not making a move based on what you're hearing market analysts say, what you hear on TV. That stay with what your objective is, what your long-term plan is. So that's my long-winded answer to our first question. Hopefully that's clear. We'll be back in just a second with our next two questions. Again, this is Money Matters. I'm Emily Johnson, and please stay with us. We'll be right back. Welcome back to Money Matters. So the next question that I want to answer, today's theme, of course, is answering viewer questions. The next question that we want to answer is, what is our view on interest rates? You've addressed this several times in the show. David Kroll has addressed it several times in the show. What's your overall view on interest rates, and how is that going to affect the market? Overall view on interest rates is that the Fed right now has been keeping rates artificially low. They did that through quantitative easing 1 and 2. They did it again through the twist program. Rates right now, Treasury rates, are at historically low levels. It depends which statistic you look at, but you hear everything from lowest level since World War II through the 70s, et cetera. So historically very, very low rates. Right now we see the 10-year Treasury at about 1.9 to 2%, and we actually see the 30-year Treasury below 3% at about 2.9%. So very, very, very low. The reason that the Fed is doing that is because they're trying to motivate people to invest, to take risk, and that can take a couple of different forms. It can be investing in equities, moving money out of Treasury and moving it into equities, or it could also be lending. It can encourage lending. By having rates low, it means that more people are going to want to borrow to invest in their own businesses and that type of thing. So that's one of the overall reasons why they're keeping rates very low. The other thing, though, that we're seeing is that our Treasury has become a safe haven simply because of everything that's been going on everywhere else. So the dollar, the Treasury have become areas of strength, relative strength, when you look at everything that's going on over in Europe and other areas that have been perceived to be safe havens historically. So despite the fact that we've had a credit rating downgrade, this is still the safest place, or perceived to be one of the safest places to be. So when that happens, we're seeing more money flowing into Treasuries, and that, of course, is keeping rates, again, artificially low. So the viewpoint, and you're also hearing some discussion of the possibility of further quantitative easing. I don't know what the statistics are on that, what the likelihood is of that, but there's still some discussion about that possibility. So I think that the overall view is that we anticipate rates are going to stay low for some period of time because the Fed is keeping it that way. They're mandating that happens through monetary policy. However, over time, I think it's fair to say that rates have to go up. And there's two scenarios where that can happen. There's the good and the bad. The good, of course, is that we see the economy start to move again, and as the economy moves, we start to have inflationary concerns. Interest rates start to go up in response to those inflationary concerns. That's the positive impetus for interest rates increasing. The negative is, again, on a relative measure, if we continue to spend more than we take in the form of tax revenues, then we're going to be in the same situation that Greece is, except in a much larger scale. When that happens, our interest rates will go up simply because we will no longer be the safe place to be. Europe is addressing their concerns right now, is addressing their spending situation. It's not pretty, but they're addressing it. There will be a solution at some point. Who knows what it's going to look like, but there'll be a solution, and they're addressing it. We have yet to actually address ours. We're substantially overspending beyond what our revenues are. We're continuing to increase our credit cards, if you will. If you want to take it to the family level, we're taking on more credit card debt at the government level than we have in the past. That's a big concern, and we will no longer be the safe haven if that continues. And should that happen, what happened over in Europe is going to happen here, and we'll see interest rates go up simply because there will be a flight away from Treasuries, and we'll see interest rates go up just out of fear. So that will be a concern. So that's sort of overall view on interest rates. We expect them to stay low, artificially low, for a period of time because that's what the Fed is seeing is necessary to keep our economy flat and hopefully growing. But ultimately, we're at such historically low levels that will have to go up. So one thing to look at now is take a look at your bond portfolios. Take a look at the overall duration of your bond portfolios. Duration is not necessarily the same as maturity, actually. They're slightly different. But take a look. Just ask your financial advisor what the duration is of your bond portfolios. Be looking to keep that very, very short, somewhere in the neighborhood of 3 to 4 years at the moment, because you're going to see less of an impact on bonds that have a duration of, in that short-term time horizon, as opposed to the 10-year, 20-year, when we start to see interest rates go up. So be looking at your bond portfolios. Consider perhaps moving some of that money into cash. This kind of gets back to the first question that we answered before. Instead of necessarily taking that money out of bonds and throwing it immediately into high dividend yielding stocks as an alternative to gain another 1 or 2%, you might actually want to hide out in cash for a little while, because there is risk in bonds right now. There is risk that if interest rates go up, that you will see the principal value of your bond portfolios to go down. So you might want to hide out in cash and little by little start nibbling at a growth-oriented portfolio if that's a possibility and if it fits with your objectives. So something to consider there, just considering what the overall perspective is on interest rates right now. So that's our second question. The third question that we've been receiving here recently, I think, was motivated by a couple of articles that have been in the Wall Street Journal and I think also in Time Magazine and a few other places on how to choose a financial advisor. And it's not as easy as it was years and years ago when you had just a few large firms and there were a few financial advisors or brokers at those large firms. The field right now is really very broad, and there are a lot of different ways to skin the cat. So I think first and foremost, and there's a broad answer for this, obviously. First and foremost, you want to work with somebody that you get along with. Somebody that that knows your objectives, that you feel very comfortable with explaining those objectives, and that you just have a good relationship with, because it's very important that you are as honest with your financial advisor as you can be. It's almost the same relationship that you have with your lawyer or your physician. Your financial advisor needs to know what your long-term objectives are, but they also need to know how much risk can you stomach. That's very important, especially in these really volatile times. You need to be comfortable calling that financial advisor whenever you have a concern. So be very, very comfortable. That's just a personality mix, and that's the soft answer, I guess. More hard answer, though, definitely want to look at the experience and the education of the financial advisors. So some designations that are worth considering, that are worth looking at. Having a financial advisor with a certified financial planner degree or designation is very important. I teach these programs. I can tell you that the curriculum is very, very complex. It takes several years to complete for most people, depending on the type of program that they go through. And then there's a 2-day exam that they have to take at the end of 6 or 7 different training modules that they've taken, depending on the type of course they have. So it's very, very comprehensive, and it's just a wonderful training. Some other designations that are worthwhile, though: the Chartered Financial Consultant, which is a CHFC, very similar training. There's not a large exam at the end of that, but very similar training, very comprehensive. Chartered Life Underwriter is more of an insurance-based designation, also good, especially if you're looking for an insurance-based advisor. There are several others. But those are the 3, and specifically the CFP is the one that I would really look at as sort of the gold standard. The other reason that one I think is a gold standard is because there's a separate ethical component there. They're not just your fiduciary if they're a CFP. They also have a separate ethical criteria that they're bound to for maintaining that designation. And I think that that's worthwhile looking at, because it's above and beyond whatever the fiduciary requirements are of having your various licenses. So that gets us to the next component, and that is, do you want somebody that is a fiduciary or somebody that's more of a broker? I think a lot of people look at financial advisors as brokers, and those two things are not necessarily the same. So you want to look at, and you might even ask, are you a fiduciary? A fiduciary is typically going to be an investment advisor that's part of a registered investment advisory firm. Oftentimes they're going to charge based on a fee as opposed to charging any commissions. And those are questions that you want to ask. Do you serve in a fiduciary capacity? And then how do you bill? There's no wrong way to do this. It's really what's best for you. A couple different ways that people will bill is based on assets under management. They might charge a flat fee for assets under management. They might charge on an hourly basis. Let's say you're just getting started and you want to keep all of your assets somewhere else, but you still need help putting together a financial plan. They might charge on an hourly basis for creating that plan, or for meeting with you on a quarterly basis to discuss what that plan is, or they might just charge for the plan. So there's a lot of different ways to skin the cat there. There's no wrong way. It really is based on what your overall objectives are. And there's so many more ways that I could go with this question. But if you have any further follow-up questions, hopefully that's been somewhat clear. If you have any follow-up questions on that, please give us a call. Again, you can reference a few of the articles that we've seen in the Wall Street Journal recently, and also in a few other magazines. There have been some great articles on this. So it's a changing landscape, but hopefully that answers your question. So those are the 3 most frequently asked questions that we've received over the last couple weeks. Hopefully I've done justice in answering them. We'll be back in just a minute with our parting shots. Please, again, follow up with any of these questions. If I haven't answered them completely, I'd love to hear your follow-up and love to hear additional questions. But we'll be back in just a minute with some parting shots. I'm Emily Johnson, and this is Money Matters. back to Money Matters. I have one quick parting shot for you that actually is going in a tangent from the rest of what we've discussed today, and that's involving commodities. We've definitely seen a huge run-up in commodities over the last couple of years, actually, and we're really starting to see that fall off. I don't think that we could say that we've necessarily hit bubble levels at this point, but certainly the growth in commodities has been approaching almost a bubble level, and we're really starting to see that unwind. We're even seeing a correlation between commodities, specifically gold, silver, and oil, and equities. As we see stocks and equities fall off, we're seeing those commodities fall off as well. There's just a large unwind in that, and just a concern that we might sort of have been approaching a bubble type status. And part of that is just due to the relative strength in the dollar, why we're seeing that fall off in commodities. But nonetheless, it's worth taking a look at your overall portfolio and seeing if you've got some gains in commodities right now, which you probably do if you've held them for any reasonable amount of time. Might be worth taking a look at that, not just commodities, hard commodities, but also the companies that produce those commodities. They also might be, taking somewhat of a hit because of the decline in those values. So starting to see that gradual unwind. Take a look at your portfolio there. It might be a place to go ahead and start taking some gains and again, repositioning. So that's my quick parting shot for today. Really appreciate your time and your questions and look forward to more of them. That's it. I'm Emily Johnson. This has been Money Matters. Have a great week.